Hey, everybody, and welcome back to another episode of Arizona Monthly Housing Market Update. I am Katie, and this is
Matt, and this is
Ryan. Welcome back, everyone.
Hey, team, welcome back. Guys, if you are finding value in these videos, and we know you are because you keep on returning, then do us a favor, click the subscribe or the follow button on the platform that you are watching or listening on right now. We appreciate it. Gives us a big warm hug, tells us to keep on doing what we're doing here, guys, right?
Yes, we love support.
We do. I mean, who doesn't? So thank you. And thank you for all that have already subscribed. All right, Ryan, take it away, my friend. It's all you. We start with rates. Here we go.
Yeah, rates. Gosh, it's been a volatile year for mortgage rates. You know, we hit 3-year lows in February, but after the war in Iran and the spike in oil prices, you know, we saw about a 0.5% jump in rates as inflation was pressured higher. So high inflation really, you know, correlates to high mortgage rates. So over the past 2 months, you know, most of the economic reports that usually impacts rates, like jobs data, we're always keeping an eye on, you know, that really took a back seat to the news on the war. So every week, you know, we would see swings lower or higher, really kind of depending on the news of a possible resolution or even if the war was escalated. So, you know, even this week, as the White House announced that they're getting closer to an agreement with Iran, oil prices went down and rates have went down with it this week. And we saw a jump in optimism and even stock prices. So today, I know we're recording on May 7th. It's a big day because Iran's president and supreme leader met to discuss the United States peace proposal. So the markets could go higher or lower depending on this response. So bottom line, you know, a peace agreement in the Middle East and reopening the Strait of Hormuz would lower gas prices, you know, future inflation and mortgage rates will go lower. So all eyes are on this possible peace deal.
Yeah, and I feel like the war in Iran kind of pushed our normal busy season a little bit later this year because we're noticing in the data that March was a little lighter than we typically see March. And now things are kind of starting to come back. Are you seeing that type of activity in your applications, in your day-to-day?
Most definitely we are. Yeah. I mean, in February, when rates were below 6%, you know, we saw a spike in purchase and refinance activity. And usually February is not crazy busy,
Right.
but it was one of the busier months. I think it was up 109% year over year applications, you know. But since rates have trended higher, you know, we have seen volume swing lower. It just kind of shows you how rate sensitive the market is. And what's interesting too is recently, you know, we've been seeing more adjustable rate mortgages are making a comeback. So, you know, it feels like if we're not really getting the rates that we're hoping for, ARMs are really a good choice to lower your rate maybe by 0.5% to 0.75. And I was looking up the data in 2021, adjustable rate mortgages were just 6% of the mortgage market. Last year, they were 21% of the mortgage market. There was a big jump, you know, so buyers are trying to get lower payments and have, you know, confidence that in the next 2 years, you know, that, you know, they could refinance, you know, there's a fixed period for the ARMs, usually 5 years. And during that period, you know, before things adjust, you could always refinance. So it's a lot of confidence that still rates are elevated, but, you know, we do see rates coming down in the next year or two.
And so you're seeing the 5/1. Did I hear 5/1 ARM?
Yep,
Is the
5/1
most
ARM.
popular?
Yep, that's correct. So it's fixed for 5 years, and those are typically about 0.5% lower than a straight 30-year fixed. So it's a great way to get a discount on your interest rate, and you have that 5-year period to, you know, try to lock in and refinance during that time, so you don't have any kind of adjustments.
And so if somebody were to use that strategy, are there any prepayment penalty obstacles that they need to be aware of at this point?
There's not, no prepayment penalties. And you know, adjustable rate mortgages, when you say ARMs, anybody who's been in the industry for a while, that used to be a pretty bad term back in 2010, because obviously with you know, the Great Recession and the market collapsing, ARMs were kind of a, you know, a reason people said that we did see you know, prices go down so much, because there were a lot of people that were in very short term adjustable rate mortgages, like a 2-year or a 3-year.
Mhm.
And there were prepayment penalties. If you wanted to pay it off or refinance, you would be heavily penalized for that.
Mhm.
So, that was kind of a different market, obviously, because prices were dropping significantly and rates were going up. But we're in a different market now, and there's no prepayment penalties, which is part of the reason they're becoming popular again.
Awesome. Thank you for sharing that. I appreciate it. Speaking of markets dropping, I'm seeing some clickbait out there in some of our local news sources that I think is sharing some pretty inaccurate information about our market. I'm seeing Phoenix market is crashing. Phoenix market is the coldest market in the country. And I'm thinking to myself, where are these people getting their data? Because guys, if you're only listening to the audible right now, if it's only in your ears, then you are not seeing what's on the screen. And I've just popped up a slide. It is information that came from our MLS system, so Armless, and it's appreciation by price range, sales price per square foot. And we're looking at April 2025 as compared to April 2026. And guys, I am not seeing any bold declines here. Am I crazy?
Nope. Absolutely not.
Seeing some very interesting increases. You want to take it away, Matt, and talk about the luxury market a little bit?
Yeah, definitely. I think this, if you look at this, what you're showing definitely says a lot. You can see where the market is lacking confidence, and you can see where the market is definitely boasting confidence.
Mm-hmm.
And anything above 1 million, it starts boasting confidence. You're seeing really nothing less than almost 2.5% from 1 million to 3 million plus.
Mm-hmm.
So, I think that says a lot about where our stock market's been. We know that stock market is one of the things that is going to drive luxury market the most. And the fact that we, hit 50,000 and then in the stock market, and then we have this war, and now we're back at 50,000, where, a lot of economists were saying, oh, we're not going to see 50,000 for a long time after this war started. And look where we're at. I think that says resilience. I think there's a lot of people there that have definitely gained confidence. And when you see that price point reacting this way, that's the one that you should really be looking at, because those are the ones that are ultimately going to be the most astute when it comes to finances and the best way to purchase real estate and all that good stuff. If you look below that, clearly you're going to see, like you said, some dips. We're seeing really no more than 2% dip. That's going to be between the 5 and 600K range, which I think is definitely what I'm seeing is an area that is saturated the most with inventory, as a buyer pool that is kind of teetering from that first time home buying single family home to, hey, maybe we need to upgrade from the condo to the first time single home. And so people are going to be a lot more budget conscious, I feel like, in that price point. It doesn't really bode well for investors to play in there because the margins aren't as big. There's a little bit more holding costs. And that's why you see things dramatically drop as you get lower, below 400K and below. They're doing well. So I think that right there just says a lot. I myself, I've seen it personally. Ryan and I were actually working with a client right now. I'm not going to go too much into detail because we are in escrow, but I will tell you that we got a really, really good deal, and it falls right in that price point. And what is really interesting is this home is a beautiful home in an awesome location. And the unique thing that happened is when it went on the market about 70 something days ago, right around the same time this whole Iran thing started, they went on the market, we'll say hypothetically, at 575. And the day they went on the market, they actually got 2 offers, and they ended up accepting an offer that was full price, no concessions. All right. Not even 2 days after, that's when the Iran war started, and it made rates skyrocket. Therefore, that buyer was no longer qualified for that property.
Ooh.
So they fell out and went back to the market. They've been now trying to price adjust accordingly to match the market since then. My client's been able to come in, and we got it substantially lower than that price. The reason I bring that up is you can see exactly how quickly things changed
Yeah.
and why that changed, and it was rate driven. So we look at it now and say, hey, what do we take with that information if we're buyers and if we're sellers? Is what I really see here is something that's temporary. And the reason I say that is why did rates go high? Well, it went because of this war, because of not just the war, because of oil, where this war was geographically located, what it was going to affect, and how it was going to ultimately affect inflation. The thing that I look at and kind of giggle and is, the politics of it. It's just interesting to see that rates are going to really look to clench on to this one little indicator, it being oil, as like the end all be all for rates to spike. Where were we at with inflation in 2023? Okay. We were at like 8%, something.
Yeah.
Crazy, right. And you have that. And then you look at where our rates were at that point in time. They're right almost where we're at now, maybe a tidbit higher. So I find it almost kind of funny in the sense of why the heck, now that we're now dancing in the realm of twos, where in 2023, a lot of people are saying that's going to take years. That's impossible to even hit 2%. And here we are. Yet we're still getting the same ramifications in rates that we were in 2023. That just tells me a lot. And I think it lines up with the fact that this is an election year. And I also think this is going to be short-lived. I think the light at the end of the tunnel is very bright based on this chart that you're showing us. Look at the confidence in luxury.
Look at the confidence.
So if anything, buyers, this is a great time, especially if you're in those price points that are a little bit saturated and you can get these great deals.
100%. And my next slide is going to show them just how good of a time it is. But before I dive into that, I want to just pick your brain a little bit, Ryan, about this chart as well. Because what I'm noticing, just boots on ground, is I'm seeing, and I want to ask you kind of where the line is that you're seeing where luxury then flips over to cash. Because we know that we've got, jumbo financing, and some people do take advantage of that, but a lot of luxury is cash. So where's that line? Do you usually see like above 1.2 going more cash than financing, or is there even a sort of a baseline there?
Gosh, I think it depends. It kind of depends on age from what we're seeing. People who are more in the retirement age and maybe have a lot of equity built up in other homes that have sold properties, coming from maybe colder climates or higher tax environments and coming to Arizona for the sun and for the lower taxes and lower home prices, they're using cash. But or the people who are making, higher incomes and they're able to afford those prices, who are younger, maybe in their, 30s, 40s, 50s, we're seeing them finance more. They're putting maybe a large chunk down, 20%, but they know, with rates in the low sixes, but the stock market typically giving you maybe 8 to 10% returns, they're like, we would rather have more of our money in the stock market over the next 20 years, compounding than putting, all cash on these home prices. So that's kind of what we're seeing is it's really age dependent.
That makes a lot of sense. I feel like the chart kind of lines up in a sense of what's in the green. So luxury is probably a little bit more, like we said, a little bit more cash buyers. And then, everything at the top of the chart in the red is going to be more rate driven because it's more finance deals.
Yeah, and it's interesting seeing how small the difference is, with between 300 and 800. There's a drop, yeah, but it's between 1% and 2%. And you can't really believe that clickbait articles, like you were saying, Katie, out there, because really the market's not crashing; it's just normalizing.
Right.
Sellers have a little less power because, we're seeing more inventory, but buyers have more choice. That they have, maybe they could ask a little bit of a lower price, ask for more concessions. But I think I was reading on the Cromford report, we're at 71 days right now, I think, with inventory, which is 2.4 months of inventory.
2.4, yeah. Excuse me, 3.
Yeah, 2.3. So that's getting closer to a very normal balanced market. I think we're remembering I think we had 1.2 months of inventory back in 21. So, we're just kind of getting closer to that balanced. And what your graph shows you basically is that it just depends on price range, depends on area, there's so many areas that are a buyer's market, but there's still a lot of areas that are very much a seller's market too.
Totally agree. And guys, we know that these news sources need to sell their news. And so what sells more than boring news, which is what our market really is right now? It's just boring. What sells more? These sensationalized lies, basically. I don't know what data they're looking at, but it's not our data. This is another one that I thought was real interesting. And this is what I mentioned to Matt, that my next slide would really support what he just said. This is probably a pretty sweet spot for buyers right now, especially buyers in that under 1 million range. We are seeing concessions increase, meaning we're seeing more concessions in more transactions. So it went from 2025, we had about 51% of our transactions with concessions. Now we are at about 52%, or just a little bit over 52. And we're still showing that the median concession is about 10,000. Are you seeing that? Does that line up with what you're seeing on your end, Ryan?
Very much so. Yeah, almost every contract that we're getting right now is showing seller concessions. It's one of two camps. We feel there's buyers who just want to lowball and ask for no concessions, or there's buyers that go for the list price and ask for enough concessions to cover closing costs, and maybe buy down the interest rate too, maybe a temporary buy down, which should get you 2 to 3% and the lower rate for the first few years of the mortgage. So we're seeing a lot of those.
Mm-hmm. And the graph shows it's a little bit difficult to see, and of course, the people who are watching, just listening, can't see. But if you look at the bar right before this very dark blue bar here, which is April 2026, the one right before it's going to be March, right? And we're seeing that climb from February to March. So you're seeing it kind of kick up a little bit there. And I think that totally lines up with what we felt during that time in the market, what we were seeing, what you were seeing with mortgage applications, kind of that paralysis when the news of the war hit.
Yeah, it just shows you how interest rate dependent this market is. It really is.
Yeah. Anything you'd like to add about concessions, Matt?
No, I just think reinforcing what you just said, and I think everyone's always trying to say, hey, when's the best time to buy? There's never a good time to buy. People, these real estate markets never really offer that runway for someone that is entering. It's very difficult for first-time home buyers. I think it's really important to look at these ingredients that we just talked about. And I do think this is a runway. If you're buying a home as a first-time home buyer, you're not an investor. You're a first-time home buyer. You're buying this as your home. Mm-hmm. And I think a lot of people need to look at that more than trying to be an investor. Investors can't even pick the exact runway when's the best time to buy. So to try to put that hat on and act like that as a first-time home buyer, or someone that's just navigating this, the price points that we were talking, even if you've maybe bought one or two homes, you're kind of shooting yourself in the foot, because if you're going to keep waiting, I think you're going to wait, and it's going to cost you a lot more money. It's also going to cost you options, because right now there's a lot of options out there. If you want a home that's turnkey, you can get that if you're in that price point we were saying for first-time home buyers, and get the concessions to move in. If you're that person that's looking for a home that's, hey, I want to do some of my own work and get in with some really good equity and create some sweat equity, guess what? It's there. You can do that. And you can probably get concessions on top of that really appealing price, which we're seeing results with. So I think that's the most important thing. Don't look at the news and say fear, 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 because this concession thing is so minute as far as its change. It could go the other way just as quickly. And right. The second concessions go the other way, I think that's because now we are seeing that really bright light as far as rates at the end of the tunnel just shining. And it's going to continue that trend. And we're going to see inventory drop, which means options are less. We're going to see concessions drop, which means you're not going to be able to leverage that money and keep maybe a little bit more in your pocket or for safety. And it's really going to create competition. And then, like everyone says, hindsight's 20/20, and you're going to be looking back at this period probably saying, oh, that would have been a good time to buy.
Missed it. Exactly. I think that Watching Concessions, nobody really talks about that a lot, but I think watching that data is kind of almost like your precursor to, like you just said, like things are going to start to change and go the other way once those concessions start dropping off. So it's a great thing to watch for somebody who's trying to time the market, even though we know timing the market is pretty tough to do.
Yeah, and outside of these concessions going up, one thing that you don't really measure is how much like repairs sellers are willing to do right now.
Ooh, yeah.
That's one thing that we're really seeing a lot of is, after the home inspections, we've had some buyers say, "Hey, the roof's old, it's a mess. Can we replace the roof?" A lot of the times in a hot market, the seller would say, "Forget it. I'm
Correct.
relisting the house." But in this market, we're seeing a lot more sellers very willing to do any kind of repairs needed to get the home sold. So outside of just financial concessions, we are seeing a lot of repair concessions as well.
That's a great point, and we're seeing that boots on ground too. One other, I'm like slide lady today, but one other slide that I wanted to share with you guys, and I know Matt's going to absolutely love this, and he has all kinds to tell us about this, I promise you. But this just came out not too long ago. It was an Investopedia article, and it shared the top 10 cities where millennials find the right mix of jobs, pay, and housing. And I only am showing 4 of the 10 on the screen here, but we are in that top 10. So Phoenix, Arizona is a solid economic base of growth and entrepreneurship, along with continued residential construction, which has allowed income growth and housing costs to improve, is kind of their little blurb there. You're also looking at Austin, Texas, Boise City, Idaho, Jacksonville, Florida, and there are 6 others. But I thought that was really cool and really interesting information. And Ryan, are you seeing a lot more millennials buying? Does this sort of line up for you?
We are, yeah. I think we have such a strong jobs market out here right now, and still, I think we have over about 85,000 people coming into Maricopa County every year,
Mm-hmm.
and a lot of those we are seeing as being millennials that are just trying to find something that's a little bit more affordable, and we are seeing a lot of that, and even if they don't really afford on their own, we are seeing a lot of parents willing to co-sign and even helping out with down payment. So just kind of getting your foot in the door and getting that first house is really the priority. So we are seeing a lot of that activity right now.
Yeah, and it's crazy too in the mom world. What I'm seeing, we all know I have that big social networking group, Mom Nation. I'm seeing a lot of moms that had their millennial age and they moved out of Arizona. They're coming back now.
Mm.
I'm getting a lot of moms coming back. I'm having a lot of conversations with moms about, hey, how has Arizona changed in the last couple of years? Brief me because I'm on my way back. I miss it. Like I need to be there kind of conversation. And Matt, you had mentioned before we hopped on the show that you're seeing a lot of positivity in the jobs area, lots of growth there. Do you want to speak to that a little bit?
Yeah, absolutely. Well, I think, one of the biggest things that we see is TSMC. I
Yeah.
mean, that's global news. That's when we start talking about the future, strength of global economies. It's all built around AI, NVIDIA, all these big companies, and they're using TSMC for, the heart and brain of what they're building. And
Mhm.
and at the end of the day, this is an industry that has many ancillary fingers that are highly technical, and they are going to all offer very high paying jobs. And so I think we're seeing that. We're seeing it in healthcare, and just tech in general. So I really do think when you couple that with, just the way Arizona is positioned with its weather, with its location geographically, as far as making it to cool, fun places in the country on cheap flights, its cost of living. We were just rated in amongst the top 10 places to live for single family rentals, just because it is actually appropriately priced. I think it's really good for millennials.
Yeah.
There's even been saying this is the place to come if you're single and you're a millennial and you're looking to meet your soulmate. This is a real good place to do that and start a family and all that stuff. So I think, I think there's a lot of things that point to Arizona economically and like more of that like personal side of things, not just so much the real estate, why you would say, hey, my quality of life is going to be good. it's not going to be a risk. And if you're in a place that's like literally a black cloud hanging over it, like California, parts of California, other cities that are just really, really taxed high. Inventory is high, and you look at those real estate markets and say, is this really worth my investment? I think a lot of millennials are saying, I don't need to be married here. I can move. And this is one of those spots.
Yeah, I totally agree. And one question that came up in a meeting that I was in last week was, well, let's just take TSMC, for example. Are they bringing their workforce with them? And the answer that I'm hearing consistently is no. They are bringing them over to train, but they are hiring from within our country for their permanent employees, I should say.
Absolutely.
Have you guys heard that?
Yeah, I've definitely heard that too as well. They're hiring people, here in Arizona. And it's not just, TSMC, even though that's a big one, but it's incredible. We're reading about Intel, obviously. They're making a huge comeback and they're growing significantly. We tend to work with a lot of people from Intel. Even like Mayo Clinic is doing a big expansion too. There's a lot of growth, a lot of jobs being created out here. It's really exciting. So I know that's a big driver of home prices. And I think that's what's giving us strength. Even during a little bit of a slower period, we're still maintaining pretty good levels.
No, absolutely. And I think you even mentioning Intel is another thing to kind of throw in what we've seen happen here in Arizona over the last 12 months. If you look at where their stock price was before, the government stepped in, they were trading at the 20s. Now they're at 104, I think, something like that today. So you're talking about a dramatic increase. This is people's 401ks. This is confidence. This is just so much more on that financial side of things that I think is just so good for the housing industry.
Totally agree. Well, folks, you heard it here first. Come to Arizona, find your dream home and your soulmate. This is where it's at. Seriously though, we have so much great news. Just be careful out there because it is a jungle in clickbait land. And I promise you, we look at the data very, very closely each and every month here right with you. And so you can follow the real data here. You know what's really going on. So please continue to do so. If you guys want to check out any of our previous episodes, hop on over to our YouTube channel. It is at Team Evo AZ. And that is our handle. Scroll down just a tad. That very first playlist is going to be the monthly housing market update with Matt, Ryan, and I. So make sure that you guys binge away on that playlist. There's another playlist that Ryan and I quite like, and it's called Real Estate Tip Tuesday. And that is a 4 to 7 minute tip every single Tuesday related to real estate or mortgage here in the local area. So definitely check that one out too. It is a great one. Over on your favorite podcast platform, do a quick search for Arizona Real Estate Radio. There you're going to find us. Remember what I said at the beginning of the show? Click that follow button. Click to notify. You will never miss a beat. And we will see you next month. Bye, guys.
Thanks. Bye, everyone.
Looking to buy or sell in Arizona's hottest neighborhoods? Meet Team Evo AZ, your Arizona real estate experts, driven by data, powered by passion. Meet Matthew Lambert and Katie Holly Lambert, the powerhouse duo behind Team Evo AZ at eXp Realty. With their talented team of agents, they're making Arizona real estate personal and powerful. Trusted, tenacious, Team Evo AZ. Team Evo AZ offers full-service real estate, powered by strategy, experience, heart, and a passion for helping people move forward. Ready to make your move? Visit www.evoaz.com and follow us on social media to connect with us.